Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. In this video, I want to go over a newly made ETF that is completely focused on SPACs, which is special purpose acquisition companies. It's going to have a wide range of different companies in this particular fund. So if you're interested in possibly investing in these newer companies that are trying to merge and acquire other smaller companies without going through the IPO process, this might be an interesting ETF for you. So let's dive in and see if it's worth it. Okay, so this article is from Barron's, just came out on October 1st this year. We're looking at a SPAC ETF making its debut. Here's all you need to know. So investors with a new way to play the markets for special purpose acquisition companies, or SPACs. It made its debut Thursday last week in the New York Stock Exchange. Ticker symbol is SPAK. Just started out. There was no huge jump on Friday, so you should be able to get in at a reasonable valuation currently. So go to Seeking Alpha and type SPAC. You'll see some of the initial conditions, although Seeking Alpha is not the best resource for this kind of things. It is something to look at and consider. So ETF comes from a record year of SPACs. There's 116 initial public offerings, raised $44 billion in proceeds, more than the last 5 years combined. Now, SPACs go public as cash shells. Sponsors later identify the SPAC, and then they merge with them together. So you could get in essentially on the ground floor, just like many venture capitalists might do. You essentially could be very early on into this process. Some of 2020's best performing stocks were SPAC mergers, Virgin Galactic, DraftKings, and Nikola at least at first when it jumped right up and then shot back down again. And then there are other holdings as well, and that's like Claravit, Veritiv, Vinvent, Smart Home, and Open Lending. The ETF's 10th largest position is an active SPAC, which is Churchill Capital, and they have $1.1 billion to merge with MultiPlan for software and health insurance. Now, one of the reasons why SPACs are able to be very popular now is they are able to get through the process to be a stock much faster than an IPO. IPOs could take long periods of time. Right now, Airbnb is likely going to be in an IPO, and Pershing Square, Tauntaun tried to acquire them and put them into their SPAC, but Airbnb wants to do IPO, and they're still working on the IPO process as well. Now, they are a bit risky because a lot of these SPACs may not necessarily merge with another company and then be a company, so the prices could be quite a bit lower. Some SPACs from high-profile sponsors trade well above their trust values, though. You want to do a lot of due diligence in SPACs, so this ETF might have some good SPACs and might have some subpar SPACs in it as well. Historical performance is mixed even when they eventually do close the deal. SPACs tend to outperform the market over the month and quarter following their deal, but after the merger is completed, new stocks tend to lag behind. When you look at this particular ETF, it is an expense ratio of 0.45, which is relatively reasonable. I thought SPAC fees would be higher, near 1% or so. So if you're investing $1,000, it would be $4.50 of money that would go back to the ETF, essentially in fees. So it's not really the end of the world with this. It started at $25 a share, up to $25.74. That was on Thursday. If we're looking at it on today, $26.33. So it did go up quite a bit in the first few days of open, but still pretty much on the ground floor of this. You're not going to be doing this for dividend plays. I don't think it's going to be paying a dividend that I know of because they're just trying to acquire companies and whatnot. Company Utz that makes a lot of the snack chips and really good fries and whatnot, they did form from an IPO, and they might actually give a dividend, but I don't think that they're necessarily going to be a huge dividend compared to this whole ETF. So this ETF might give a very, very small dividend, maybe 0.25, 0.3% or so. So if you're interested in a diversified portfolio of SPACs instead of buying a lot of individual SPACs, this ETF might be for you. The expense ratio of 0.45 is reasonable for what this ETF is doing. It's not completely passive indexed, just like index funds, because they need to constantly acquire new SPACs as they come in. There are some pretty high-flying SPACs, and there's going to be quite a few that are not very good SPACs. A lot of their business numbers, and when they're looking through the fine print, won't be very good in terms of long-term profitability. So you want to consider that. I know some other investors are investing in individual SPACs. I personally have one in Pershing Capital Tontine, which they currently don't have an acquired company yet. Stock price has been hovering, pretty much hasn't moved in the last few months. And me personally, I don't like necessarily investing in a lot of these companies that are just based on capital gains and not dividends. I'm more of a dividend investor. I do believe in Bill Ackman quite a bit, so that's why I put money into this one. When you're looking at the ETF form, again, it will be much more diversified than individual companies, so it is something to consider. But there's going to be a lot of companies that will not be very good in it, and I don't necessarily think it's worth the risk. If you are going to be investing in SPACs, you could either do individual companies or do this ETF, and the ETF might be worth it for a small percent of your portfolio. So again, I'm the investing teacher, high school science teacher, teaching others how to invest. If you have any questions, thoughts, please like, sub, leave comments. I read every comment that we get, and look forward to talking to you guys next time. Have a good one.